Hey guys, Marty with Options Unleashed. Welcome back to another video. Today's video is going to be on volatility. What's volatility all about? IV, HV, IV rank, expected move, and how we apply that to option trading. Volatility is a pretty boring subject, so we're going to cover, like I said, implied volatility, some standard deviation, implied volatility versus historic volatility, IV rank, and again, some option strategies for how we apply volatility for options traders. This is the number 2 video in the series of what I call option trader pillars. This is the understanding volatility section. The first video, if you didn't catch it, please take a look. It's on position size. We consider position size the most important aspect of your option trading. Number 2 is volatility. We're going to talk about why it's the X factor in our trading, period. It's the single edge that we have in maximizing profits. We'll review implied volatility and how that compares to historical volatility, standard deviation, all that. So let's talk about some definitions. First, volatility refers to the amount of dispersion or stability in a given system. With respect to stock prices, higher volatility implies more uncertainty and more risk. With option trading, implied volatility is calculated based on the options price of the underlying and expressed as a percentage. We often refer to this as the current implied volatility. This is the most important distinction, guys, that the implied volatility is really based on the option price, not the stock price. Something to consider. So best practices on standard deviation. Standard deviation is a statistical measure now of the amount of dispersion of the system of the volatility. It is the square root of the variance, or in other words, the square root of the average squared deviation from the mean. What does all this mean? Basically, it means that the standard deviation allows us to express volatility as a statistical number, i.e. sigma. So it allows us to express volatility in a mathematical sense, right, so to speak. So because stock returns are Gaussian or normal distribution, we talk a lot about standard deviation so that we can talk about how it applies to returns, such that once we can apply a standard deviation to the volatility of a stock, we can then determine what price levels we want to pick for our option trades. So you guys have all seen this before. This is the standard deviation bell curve that you're familiar with, probably from early math class, statistics. The important thing to remember here is that the numbers are 68%, the 95, and then we'll get into later the 84% and the 16. But the most important thing to remember is that stocks have a 68% chance of falling in that one standard deviation move. So it'd be above and below the current price. Then we have what we would consider 2 standard deviations is the 95 percentile, or the 2 standard deviation move, which means that a stock would fall within that 2 standard deviation move about 95% of the time. And then later we'll talk about when we're selling premium or we're buying premium, we would tend to look, if we're considering a 68% move, then we would consider selling a short put, let's say, if we're bullish on a stock, or a short call if we're bearish. But on a short put, we would consider selling an 84% out of the money option. The reason why it's 84% is the 84% would include this one standard deviation move here on the left hand side, so that we would expect the stock to come all the way down and test this one standard deviation move. But then the percentage of return that we would expect on the right hand side would total of about 84%. So those are just some important things to remember. When I first started option trading, I wasn't sure why people were picking the 84% levels. And then if you just do the math, you'll see that 84% is really the 34, the 34, the 13, the 2, and the 0.1 all added up. So just be careful when you're selling premium. You don't want to target the 68% area out of the money. You want to target the 84% out of the money. That gives you a 1 standard deviation move. If you are interested in targeting a 2 standard deviation move, which is a safer play, a very safe play, that would give you that 95% probability that it would be within 2 standard deviations. Then you would be looking to sell even further out. It would be about a 94% out of the money move. So those are the numbers to keep a look for. So implied volatility is what we call current volatility. It's measured by the conversions function of the Black-Scholes algorithm, which uses the current stock price, current option prices at the money, out of the money, as well as certain option Greeks, which can be used to converge on a value for IV. Implied volatility is kind of calculated for you by your brokerage, and you can find that in the platform. We use the Thinkorswim platform, or you can find it in Tastyworks or Fidelity. Any of the platforms that you use should be able to express implied volatility. And then historical volatility is the actual or historical measure of the underlying over time, usually about 1 year. So given that we have an implied volatility or current and then an historic, we can calculate what's called IV rank. Don't let IV rank scare you or fool you. IV rank is basically just a normalization or index calculation that we use, and it's just a ratio of the IV to the HV, and it's normalized as a value between 0 and 1. So once normalized, then we can compare it to, say, all other stocks. Expected move is actually something that is really important for trading. It's another term for around a one standard deviation move, and we use this often to describe earnings events. Earnings events is typically looking for expected moves, and we usually try to trade sell premium during these periods of high volatility. We can also do this manually by calculating 85% of the value of the front month at the money straddle. So if your brokerage platform doesn't give you the way to calculate expected move, you just take 85% of the value of the front month at the money straddle at expiration, and that gives you about the expected move that you could expect. Add the price of the front month at the money call and the price of the front month at the money put, and then multiply the value by 85%. We also just take an average as well. That's another way of doing it. It's close enough. But why is this important? Understanding volatility for stock gives us insight into how risky a stock can be, looking at things like its beta, performance relative to the S&P, and expected moves during earnings. Understanding IV for option plays helps us determine if we should be selling option premium or buying option premium. So here, let's look at a standard deviation chart put in perspective of different levels of volatility. This should bring it all together for you if you don't really understand the concept of when to sell and when to buy. Notice how down here, when you're in the light green at the bottom, we're selling premium down here. This is where this would be your log normal distribution or just regular distribution. Don't worry about the log normal distribution when we talk about stock prices. The reason why they call it log normal distribution is that basically stock returns don't exactly follow a Gaussian or normal curve. They're somewhat log normal in the fact that lower price stocks tend to not necessarily move in the same fashion as higher price stocks, because when lower price stocks they never really go to zero, and they kind of hover. Once they get below the $1, they kind of become penny stocks, and that kind of throws off a lot of the math. But don't be worried about that. Just consider that the stock prices movement in the time frames that we're talking about for options between 30 or even 20 or 10, between 10 days and up to maybe 6 months or a year for leaps. They're still very powerful in terms of matching a normal distribution. So when volatility is high, like 30%, you can see that the curve out here is basically a shorter, fatter curve. And this tells you that those prices, with all prices equal, that you would expect to include these higher prices on the call side and lower prices on the put side during an event, particular like an earnings play. Whereas if you're looking at something that's very low volatility, like 13% volatility, let's say, you get a narrower, skinnier curve. And so what we tend to see is that low probability events will turn into higher probability or larger volatility events. It'll become larger volatility when there's a certain event like earnings or a headline risk or things like that. Whereas when you have higher volatility over time, once an event is known or once the information is known, then it would return back to lower volatility. So let's look at how we can look at volatility in the different platforms. Here I have pictures of like Thinkorswim, and we can use Thinkorswim to look at IV over time and calculate the IV rank and things like that. So in Thinkorswim, you can see that you can graph the implied volatility at any one time. Notice that in this graph, we have the effects of COVID-19 showing up in our historical volatility or our implied volatility back almost a year ago. You can see the implied volatility spiked during COVID-19, and that kind of throws off all the math for the IV rank. Nevertheless, IV rank is still a valuable tool, but just be careful when you're using IV rank in periods of massive volatility changes across the market. You might get numbers that are skewed to any one particular side. But nevertheless, it's still a ratio, and it kind of shows you that when IV is high, we would tend to sell premium, and when IV is low, we would tend to buy premium. So the IV rank is important to look at. So currently, let's say on this particular security, Apple, it was 13%, meaning that basically you have a 13% probability that future probability to be lower than the current IV right now, which would tell you that there's like an 80, 85, 86, 87% chance probability that the volatility will increase in the next expiration. So another thing you can do in your platforms is you can add implied volatility to your watch list, and then you can sort your watch list by implied volatility descending or ascending. So in this case, I have added a column in my Thinkorswim platform for implied volatility, and then I can use these. I can take a look at any of these securities on any given day, and I can see who's creeping up in implied volatility, and it usually means that they're getting near an earnings event or some other type of event. But this can happen for any reason. So it's kind of good to keep indicators in your watch window to see at any given time. If you're trading options, obviously, you want to know when the best time is to sell or buy option premium. Another way you can look in the platform, I don't use this very much, but you can look at the probability analysis. Again, it's just another way of looking at standard deviation. If you think of it, this is just your standard deviation curve that is set to the probability range of one standard deviation. That's 68%. So the platform automatically will graph that standard deviation and give you that probability mode of in the money or out of the money, different types of modes that you can select here. And then you would select your expiration that you're interested in this case, March 19th. And then you would be able to see that for Apple, what the ranges are. The platform would just tell you what the expected price moves would be, so you can quickly take a look at the prices then in your options chain to find out if you're interested in selling or buying premium. So what's Vega? So Vega is a measurement of the sensitivity to changes to implied volatility. And that's one of the options Greeks, and we'll do a future video on options Greeks. Basically, the way to think of Vega, and a lot of people remember it as V is like volatility. So if you forget what option Greek is volatility, you can just say it's like starts with a V, so it's Vega. So if you think of it too, like as delta, or for me anyway, as delta is to price, Vega is to implied volatility. So as delta is kind of it is a measurement of the sensitivity of price changes, Vega is as a measurement of sensitivity to changes in volatility. Vega is implied volatility, expresses the change in the price of the option for 1% change in vol. Volatility skew is another term you'll hear. Don't be too worried about this. It's just a relationship between the out of the money option prices versus the in the money and at the money prices. Out of the money, lower strike prices tend to be more expensive, as traders are typically willing to pay more for put options than call options. And that's usually because like stocks will sometimes, with headline risk, they will take the escalator up and they will grind higher, but then they'll take the elevator down on a negative news event. So that's why you have volatility skew. A lot of people ask why option prices are more expensive on the put side, and that's normal. So how do we apply this to all our options? It's the holy grail of option trading. We tend to sell premium, selling puts and calls when the IV is high, and we buy premium when the IV is low. So here's an example earnings trade that we had on Twitter. We had earnings on February 9th, and the February 12th expiration average IV was 125%. So this was a great candidate for selling premium, out of the money calls, puts, short strangle, iron condor. We would look at 84% out of the money calls and puts. The current IV is elevated, you can see on this chart. So let's take a look at one trade that we did actually for February, that we sold this February 12th, 48.66 strangle for $1.51 credit, had a 92% probability of profit, and it had a 572 buying power reduction with infinite risk. So you got to understand when we say infinite risk, really just implies to selling naked puts or naked calls. For earnings events, your infinite risk is kind of a relative term. You're obviously exposed, but you're not holding these naked calls or puts for any like huge amount of time. There is risk obviously in buyouts and things like that, headline risk. There's always risk with trading options, but the short strangle is probably one of the most popular option strategies for earnings that traders make. There are a couple things you need to be careful about with the short strangle. This video, we won't go into it too much because we're just really talking about volatility and what to look for, but we will probably talk in the future about different option strategies, the short strangle versus the iron condor, for example. We'll talk about the pros and cons of the probability of profit versus the buying power reduction and the actual risk. So for this example, just what we want to show here is that for this 48.66, it's a very wide short strangle collecting about $1.51 credit, which is a really good return for this particular trade. It's got a 92% probability of profit. And it has a $572 buying power reduction, which could be significant if you are selling, have a for small to medium sized accounts. That might be problematic for you because you're going to need that 572, but more importantly, if the stock goes against you, you're going to need extra cash, and we talked about that in our position size video. This is a very good way of playing earnings plays. So this was a really good trade that we had on. Another example would be just to sell, and this is a lower risk trade because it does involve buying protection. And so you've heard about these before. This is called the iron condor, but this would be selling the February 12th, the 47.5 48, 66, 67, iron condor. So you're putting together a short credit spread and you're putting together a short bull spread to make that iron condor complete with 4 legs. And down below, I showed it as 2 verticals just to show you what we're collecting here. We're collecting 15 cents for the short bull spread and the credit spread, and we're collecting 10 cents for the short call spread. And so this nets about a 25-cent credit. Remember that the previous trade was like $1.51 credit. So this is much reduced in terms of your overall profit, but your buying power reduction will be drastically reduced in this case, and it's a safer trade for small accounts. And the probability of profit in this case is roughly the same. So let's look at one more trade. Let's say that you're not happy with that 25-cent credit. So you bring in the strikes a little bit because you're feeling a little bit more, you want to take a little bit more risk, but you want more reward, but you still want to have the protection of the iron condor with your long calls and your long puts out on the wings. So this would be bringing those strikes up to inside that 1 standard deviation move. It would be the 51.52 and the 63.64. You'd collect almost double that now. So you're at 45-cent credit. You have a 67% still probability of profit. So your probability of profit is still about a 1 standard deviation, if you will. And so it's a little bit better trade if you're considering the 2 iron condor trades. This one might be a little bit more risky, but you're getting almost double the profit in this case, and you're keeping your buying power reduction relatively low still. So it's these trades though in particular, we won't go into the again the pros and cons of the iron condors right now. But these trades in general, you would leave on because you already have your protection built in. You wouldn't really try to adjust these trades. Whereas the other trade with the short strangle, you have a much better chance of adjusting the trade. So I would say in the medium to large accounts over especially over 25,000, but even over 40,000, I would say you have a much better chance of adjusting the trade. Also, you're going to find in those larger accounts above 40,000 and above 40,000, you're going to find that people are placing many more of those short strangle trades only because you have a lot more advantages in terms of adjusting. So when to use and why to use IV. Remember that volatility is the measure of dispersion of the stock price, right? The current implied volatility is calculation on the option price. It's a derivative. We typically see that high IV will tend to move to lower IV and vice versa. So selling premium at a higher IV will tend to take advantage of volatility moving from a higher dispersion to a lower dispersion. Similar to diffusion or, what they call osmosis, right? How water gets up a tree, diffusion, you have a higher concentration moving to a lower concentration. Same thing with stock trading or stock prices, sorry. You have a volatility will move from your higher dispersion to a lower dispersion, and then we call that IV or vol crush, and we tend to sell premium during periods of higher IV for that reason. So in conclusion, volatility is the holy grail of options trading. We want to understand the current implied volatility in options pricing can greatly affect your option strategies. Generally, we sell premium when IV is greater than 60% and buy IV when it's lower than 40% or even much lower. Understanding how Vega and Delta, as well as Delta and Gamma, can affect your current trades management, and be mindful of earnings events and other sentiment conditions, as well as the broader SPY and VIX. Okay, so let's take a look at a real life example. Let's take a look at just a security that I like to follow for the reopen trade, Ulta Beauty. Here's the weekly chart. You can see it's kind of in a nice uptrend. It's been kind of trending up since those lows back in March due to COVID-19. Here's an example of how we might use volatility to our advantage, or and decide whether or not we want to place a trade. So as you can see in my TOS platform, I've got a couple things going on with respect to volatility, always kind of looking at implied volatility. So down below I have the implied volatility, the current chart of implied volatility. You can see again that spike due to COVID-19, so it's going to throw off some of the IV rank numbers for us, right? This is the weekly chart. If we switch to the daily chart, it's showing the IV rank is 17%. Again, that's going to be skewed because implied volatility was so high back in last March. So the current implied volatility is around 50%. Another thing you can do here is I've added it to my watch list, so you can see I've just added a column. You go into Thinkorswim, you say customize, and you type in what you're looking for, in this case implied volatility, and you can see there's a couple of them here. There's implied volatility, I think this is the rank, and then this one's the actual percent that we're looking for, the current implied volatility. So I added that to my view, and then I can sort these by like high implied volatility to low, and I can take a look at whatever I need to look at the time. Right now we're looking at Alta, it's 51%, and I can also come in here and look at another way of looking at it. I can look at the implied volatility for the particular expiration. So a lot of these values are just average implied volatility. Remember, we talked about implied volatility as being a calculation based on the option price, not on the stock price. So you're going to get different IV numbers, IV percents, based on different expirations and different amounts of vega and delta, and just different levels at different times based on the algorithms. Because again, the algorithms are used to back into particular numbers based on the option trading, the volume, the price, and so on and so forth. So there's a lot of complexity that goes into it. So that's a whole nother video, but nevertheless, what we would look at is I typically look for options if I'm going to sell premium in this case. Like we told you in the video that we would look to sell premium of 60% and above. We're only at 50% for the March 19th month, about 34 days to expiration. But I'll just go through an example of in here of what you would be looking at to place a short, if you're bullish, a short put strategy. So you would, another thing you can come in, and when you see your option chain, Thinkorswim and so does Tastyworks, they allow you to change the view to include, various columns that you want to see. In this case, we want to see the implied volatility, probability out of the money, and delta. These are kind of important to sellers of premium. We want to be able to look at delta right away and that out of the money, the percent out of the money, probability of out of the money trade. So when we open up that 19th of March, we can come down here and we see the call chain and the put chain, and we would want to see that the probability of out of the money, if we want to include that standard deviation, one standard deviation move again, we said in that video that we want to target the 84% out of the money, and that 84 number again was because we want the 34 plus the 34 plus the 16 plus the 2. So we want about an 84% chance of being out of the money selling that put. That means that the buyer of that put would have a 16% chance of being in the money. So we are selling premium in this case to people who think the stock price is going to go beyond the one standard deviation. They have a 16% chance. Now, another kind of neat way to look at this is you can use delta. Delta allows you to see, what is delta? Delta is the price sensitivity to the underlying, right? But also keep in mind that delta is almost equals the probability as well of that price being at that certain level for expiration. So if you can see, this is a 14 delta, we say. We multiply that by 100 and we say that has a 14% chance of being in the money. So you can see that if you're looking at an 82% chance of being out of the money and a 14% chance of being in the money on a completely different Greek like delta, they're about the same, but not always. And we won't go into the details, but if you're looking at a good quick measure of probabilities, we typically look at our probability of out of the money, and we also look at what we're selling that delta for. And so when we look at high IV strategies, we want to target the 82 to 84% probability of out of the money, but we also would like to see that delta a little higher. So we're looking at the probability of out of the money between about 84%, just to give us a rough gauge of where we want to start the process. But we also we want to see what that delta is saying to us as well. Typically, we want to try to get as much delta as we can out of the trade. So in this case, it says that it's only a 14 delta. We can move up to a 30 delta, but then notice that our probability of out of the money is lower. So if we want to just show on the platform, picking that 82%, because we have 87, 82, we'll pick that 275 strike price and we'll click on sell and we'll model that up here. And then we go up here and we set our expiration up here window to the March 19th date. And this shows you that gray area here, shows you the one standard deviation move. So you can see that our option that we picked at break even is about 82%, like we said, which includes almost the 84% one standard deviation. So we were pretty close. So this shows you the probability of profit at break even for expiration, and this trade would be collecting $3.50 for this trade. But notice, so the question that you would ask would be, is this a good trade or not? So that's a subjective question. It's only up to the seller or premium to decide if this is a good trade. If you're dying to get into the trade, you might take it. If you if you see that it's got a good the good credit received that you're getting here, $3.50 isn't a bad credit received for this particular price, for this particular stock. So it's all very subjective. You can also combine this with selling that. You can actually make it a strangle like we talked about before by also selling that 84% out of the money call for another $3.60. That would double up and then give you a $7.10 credit. But now you have risk to both the upside and the downside. But just sticking with the short put strategy, this just gives you an example of what to look for. And the reason why we target the over 60% volatility is we would consider that standard deviation for when the volatility increases from 50 to 60 per se. We would expect that one standard deviation move to move outward. It might include maybe the 260 strike. But if we kept our levels at if we kept our level at 275, then we would be collecting more premium for that trade. So it just depends on how you want to do it. I might also come in here and instead of 350, I might anticipate the fact that vol is going to increase. If we go back to the chart and we look at the daily, we can see that the IV rank is increasing ever since last month. We've got earnings on 3/11, so we know that IV rank is going to increase between now and March 11th. So it's pretty much just a subjective. You're in a subjective area in here. You're kind of in no man's land a little bit. You know that volatility is going to increase, so you might want to wait before earnings to make that earnings trade. But let's say that you don't want to wait on the 3.8. Don't forget that this trade, the 3.19, is actually well past earnings. So If you're not interested in waiting, you can go ahead and place that $3.50 credit, and you still are, you still have that 84% volatility, that one standard deviation move, but just know that the volatility between now and then can go higher. Another thing that you can do is actually say that I want to have a limit order. You can say that I'm not really ready to sell this premium at $3.50. I would like to get it for $3.90, and you'll see that the platform will go ahead and adjust that for you, and you can lock that, and you can go ahead and put a limit order to sell that particular contract for $3.90. It's all up to you on the strategies that you want to use. Hopefully this gives you a good example of how we use volatility, what the various definitions are, the difference between IV rank and implied volatility, the effects maybe of Vega on our trades, what we look for in terms of selling premium. We would look for those periods of IV implied volatility greater than 60% to make it worthwhile to sell premium, and we would look for IV of lower than 40% or even lower to go ahead and buy that premium. Hopefully you liked the video. Please give it a like and a thumbs up. Please comment in the notes below and hit that notification icon, and we'll see you soon. Thank you for watching.